Welcome back, everyone. I'm here with Chapter 12, Investing in Stocks. What is stock? Stock is basically shares of ownership in a publicly owned company. Stockholders are people that own the shares. As the first bullet says, nearly 50 million people own stocks in the United States. Stocks are a great investment tool for people to use. There are two ways that you can make money with stocks. The first is dividends, and the second is a capital gain. Dividends is money paid to the stockholders from the profits of that company. A dividend is kind of like interest earned for holding that stock. It's quoted as a percentage. So a dividend is kind of like a thank you from that company. Not all companies pay dividends. The second way to earn money with a stock is through a capital gain. A capital gain is recognized once you sell the stock. So for example, if you buy a stock for $25 and the value of that stock increases to $35, yes, you have earned a gain in that stock and it has increased in value. However, it is not a capital gain until you sell that stock. There are two types of stock that you can own: common stock and preferred stock. Common stock is the most basic form of stock ownership. It can pay a variable dividend, and it entitles the stockholder to voting rights. Voting rights are given one vote per share of stock that you own. So as long as you own common stock, if you say have 100 shares of a stock, you have 100 votes. Now remember, there are millions and millions of shares of stocks in companies. Preferred stock is the other type of stock that you can purchase. Preferred stock pays a fixed dividend and has no voting rights. Preferred stock is considered less risky compared to common stock. The dividends a lot of times may be lower than that of a common stock. However, the dividend a lot of times is guaranteed to be paid, whereas with a common stock, the dividend can fluctuate depending on how the company is doing in the market. There's a variety of different ways that stocks are classified. This slide includes the ways that stocks can be classified. There's income and growth stocks. An income stock is one that can generate an income. It typically pays a high dividend. Remember, dividends are paid through the profits of the company. So a company may decide to pay a dividend with the profit they have earned. Whereas with a growth stock, that profit is reinvested into the company so that it can grow. One example of an income stock that I can give you is ETP, Energy Transfer Partners. This stock is an income stock as it pays a very high dividend. A stock that's a growth stock that you're very familiar with is Amazon, AMZN. This stock pays no dividend as the CEO believes that reinvesting the profits into the company is the best move for the company's history and future. The next two are emerging versus blue chip stocks. An emerging stock is a new stock. A lot of times it's a small, young company that has not been around for very long. These stocks can be very risky as there's not much history with that stock. Many emerging stocks are what's known as penny stocks. So they're a very low price, and a lot of times they are very, very risky because there's no guarantee that that company will really take off. The opposite of an emerging stock is a blue chip stock. A blue chip stock is a stock of a well-established company. They have a solid record of profitability. A couple examples of a blue chip stock would be Johnson & Johnson and UPS, Walmart stores. These are stocks of companies that have been around for many years and they have an established history. The next two on this list are defensive and cyclical. A defensive stock is a stock that's going to pay a dividend so that during an economic downturn, that stock can still fare okay. You as a stockholder will do okay by owning a defensive stock. An example of a defensive stock would be, say, Boeing, because that company, no matter what is going on, that company will do pretty well because airplanes are always going to be needed, whether it's for um, just regular people going on vacation or the military or anything like that. Another type of stock is a cyclical stock. A cyclical stock works with the business cycle. So when the economy is doing well, that stock will be doing well. However, when the economy slows down, a lot of times the value of that stock can decline. So an example of a cyclical stock would be Royal Caribbean, the cruise line. If you think about it, Royal Caribbean a lot of times will be doing better while the economy is booming because people have more disposable income to be able to go on nice vacations. However, during an economic downturn, people pull back on the number of vacations they go on. Two other characteristics of stocks, the market value and securities exchange. When you see on TV how much a stock is listed for, that's the market value. It's the current price of the stock that it's being bought and sold for in the marketplace. And that marketplace is the securities exchange, which is where the stocks are being traded. The New York Stock Exchange, NYSE, NASDAQ, and the AMEX, American Stock Exchange. These are where the stocks are being traded. Another term that I'm sure you have heard about on the news is a stock index. DJIA, Standard and Poor's, NASDAQ. When you see on the news the highlights of how the markets did for the day, you'll see a lot of times the Dow was up, say 300 points. That's the DJIA. That's the Dow Jones Industrial Average. And this is an index. What it is it's a benchmark for investors. A lot of times, if people don't have enough time to really see how their individual stocks did, they can really use the DJIA or one of these other indices to help them see if their stocks did well or did poorly that day. A lot of times where the stock is listed and whether it's within one of these indices will be a great indicator. Like for example, Apple is a stock that's listed on the NASDAQ stock exchange. If the NASDAQ was up, say, 60 points in one day, a lot of times stocks that are on that NASDAQ stock exchange will have done fairly well as well. Two ways to classify the markets are bull and bear markets. A bull market is a period of rising stock prices and overall investors feel optimistic. It's a good time. The stocks are booming. The economy is doing well. People are buying stocks. The opposite of that is the bear market. A bear market is pessimistic. Stock prices are falling. People are selling their stocks. So these are two ways that if you ever watch financial news, they may call the stock market bullish or bearish at certain times of the year. So this a lot of times can be good indicators whether you should be buying or selling your stocks. These listed on this slide are the different investing strategies you can use. There's some short-term and long-term strategies here. Buying on margin, selling short. These two strategies are short-term techniques as well as very risky techniques. When you're buying on margin, you're borrowing money from the broker in order to buy more stocks. This is a very risky technique because since you're borrowing the money, if you need to pay it back, which is known as the margin call, it doesn't matter if your stock is up or down, you need to repay that money. Selling short is another type of risky short-term trading techniques. A lot of times people think sell short means just a short time frame that you're going to sell the stock in. That's actually not the case. When you sell short, you're in a sense borrowing shares from the broker to sell in hopes that the price goes down when you need to repurchase them. So I'll try to explain it to you on here. If you know a stock is going to decrease in value, you have a hunch about it. You can decide that you are going to sell short, say, 3 shares of a stock for $10 each, so that you would sell the shares, those 3 shares for $10, you would receive $30. So at this point, yes, you have more money. However, you need to replenish those 3 shares. If those shares drop to say $5 a piece, you could rebuy those shares and lay out $15 to buy those 3 shares, replenish those shares that you had borrowed to do your sell short, and you have earned $15. This second blue bullet lists various long-term techniques for trading stocks. Buy and hold is a very common strategy people will use. A lot of times this strategy is when you are going to buy, say, a blue chip stock, and you're going to buy it and hold it for a long time frame. While you're buying and you're holding your stock, if a stock split occurs, that can be a great thing to happen. So for example, if you have 1 share of a stock valued at $100, your assets, that stock is valued at $100. That stock could split into 2 shares of stock valued at $50 each. Your overall value of the stocks is still $100. However, you now own 2 shares of stock valued at $50 a piece. A lot of times companies will do this if they feel as though the value is too expensive and they're hoping more people will buy the stock if they split it and create more shares. The next listed bullet is dollar cost averaging. This is the method of simply investing the same dollar amount in stock over strategic specific times. So instead of buying, say, 5 shares, you may buy $500 worth of that stock at certain times of the year. All that value of those stocks is divided and creating an average price of what you have paid. Direct investment. This is considered a strategy as you're directly purchasing stock from the company rather than buying it through a broker. And lastly is dividend reinvestment. Dividend reinvestment is a great thing. Like I said previously, if you earn a dividend, you're earning interest for holding that stock. So what happens is the company pays you the dividend in cash. However, on your end with your brokerage account, you could say that you want those dividends, that amount of money, to be reinvested in shares of stock. So instead of getting, say, $50 when the dividend is paid, your brokerage will take that $50 and invest it in $50 worth of stock. So you're actually increasing the number of shares using dividend reinvestment. This is great to do when you're doing a buy and hold strategy. That's it for Chapter 12, Investing with Stock. Make sure you read up on all of the great information in the textbook.